Now I want to talk about specifically more the stock market. So a lot of people are looking at the S&P 500 and they're basically saying that the S&P 500 is expensive, right? Specifically the PE ratio, right? A lot of people are saying that stocks are expensive, and that makes it another big reasons why stocks can likely go down more in the next upcoming months. But that's sort of black and white, and I can show you why. If you look at this dotted line right here, this is the average since 1957. But if we look at back over the 10 years, PE ratio has been about 23.63 times, right? And this is from Guru Focus. I've read from another analyst that it was about 18. That was the average. So what I'm going to do is I'm just going to take the middle. I'm not going to take each standpoint. This is saying 23. I've read from another, it said 18. So that's a difference of 5. So let's say to be conservative that we take about 20. 20 is the average for this PE ratio. Whenever the PE ratio is below the average of what the length of what you're seeing, specifically the PE ratio, if it's below it, that means that that stocks are cheap. And specifically the S&P 500 is cheap. When it's above that average, it means it's relatively expensive. What position are we at right now? It's 18. So you might be saying, like, that makes no sense then why are people saying that the stock market is expensive? Well, it's simply because the thing is, over the past 10 years, interest rates have been very low, right? So because of this, even though that you see over time it's been at 20, if we take the average, right? It's been averaged by 20. A lot of people are concerned because if interest rates right now are high, why are they at the same or a little bit lower compared to what they have been, right? Because if interest rates were higher, this number should be a lot lower. It should be probably like at 13 or 14. Plus, one of the things that people don't know is that the PE ratio is too black and white. Because the thing with PE ratio is that it never factors in the company's growth in the future, and it never factors in the company's cash flow. There's a lot of people usually say, oh, the PE of a company that's 30 is way too expensive. And not exactly. Like, that's not true at all, because it's simple. If a company has a PE of 30, but its growth rate is more than 30%, that's not expensive. You know, that's not expensive. In fact, it's fair. And sometimes, you know, even if a company has a PE of 5, it could be expensive. That's why PE is not reliable just as of itself. You need to look at it from another perspective and to add additional research, because if a company has a PE of 5, but their growth is less than 5, then that's actually more expensive compared to a company who has a PE of 30. So you see, like, that's why it doesn't make much sense. And right now, you can see that the market, because the S&P 500 just has the 500 biggest companies. So it's taking the earnings of each of these 500 biggest companies. But as of right now, a lot of these companies are actually pretty undervalued. So that's for the PE ratio of the S&P 500. You can see that it's cheap based on that, from all these problems, because you had wars, you had bond crises, you had bubbles, you've had all these type of things, and there's so many reasons to sell. But if you just holded a company over years, you would have made this astronomical return. And that's what I do, you know, and that's why I take advantages of crisis, because crises make very valuable businesses undervalued, just not because they're worth less, but because people think they're worth less, not because of the business, but because what's around the business, what's happening macroeconomically, or what's happening in the industry that's not solely dependent based upon what they're actually selling, whether they're selling products, whether they're selling services. And that's why I take advantage of that. One of the greatest things that you can have in your mind as an investor is simply to see the stock market as an auction market. The stock market is just simply an auction market. The stock market is simply auctioning off an asset to people and it's up to people to raise or lower the price based upon how much they think that asset cost. But a lot of the times what reflects people's thoughts on what that asset's cost does not reflect what its worth is. Because look at Amazon's case. I remember in Amazon 2022, when Amazon was reporting lower earnings, many people sold heavily out of Amazon. And if you actually looked at the facts of why Amazon's earnings went lower, was simply because they reinvested a heavy amount of cash into their R&Ds. So when they're investing heavily amounts into their R&Ds, that raises their cash flows higher because they're making their businesses more valuable. They're making their products and services much more established. They're making it much more dominant in their market, which makes their product dominance a lot more better, which makes their sales likely to go up in the future. But many people don't see that. Why? Because they buy stocks as stocks. They don't buy them as businesses. And because they buy when others people want to buy. So don't be that way. Okay. Don't be that way. Just take the advantage right now. If stocks go down more, please don't sell. Sell if you have a bad company. Like, you should not be holding a bad company. If you're not sure whether your company is valuable or not, make sure to do the statements. We teach that too in Selection. We teach how to read companies and know whether they're valuable or not, and what companies you should avoid. So if you're interested in that, we have it in the description. But if you're not, be very cautious, because stocks could go down. You know, stocks could go down maybe in the next 6 months. Like, no one knows, but probabilities they could go up in a month or so. Okay. If you're trading, you should be taking advantage of this, because usually when markets are tending to come down, there's usually more volatility. So that could bring a lot of your trades to go up to your profit targets a lot more faster than you thought, because there tends to be a lot of volatility when markets are dropping. When markets are going up, there doesn't tend to be a huge amount of volatility, but sometimes. So either way, if the markets drop, take advantage of it. And if you're trading, well, you make money despite if the market's going down or up, right? That's the point of trading. If you're investing, hold them as their businesses. Okay, so that's it for this video. I hope you guys enjoyed it. We usually talk about this type of stuff in this channel, and we usually do talk about companies internally, whether they're valuable or not, whether the market is factoring in the price to an irrational price of what it is for an investor. And if you're interested on that, just look forward to this channel, because we do publish that. Okay, I'll see you guys in the next video. Bye. Beat the hell out of inflation.